Hello and Assalamu alaikum students. I'll welcome you all on the fifth and the last day of Practice to Pass webinar for the Advanced Taxation Exam UK variant. This is your tutor Mia Saad Mohammed. So guys, as you know that till now we have covered the 20 marks question in the first 2 days, the 25 mark question on the third day and 35 mark questions on the fourth day, and on all days I have made sure that the question that I have selected revolves around all sorts of taxation. So we are not focusing on any particular tax, either the individual ones or the capital taxes or the corporation taxes. However, in today's question, my prime focus will be on corporation tax and VAT. So the questions I have selected today for you can be found out from the ATX Day 5 questions handout that you can download. The first question that I have selected is Nocturne Limited. And before I start that question, I would like everybody to raise their hands if they can see my screen and if they can hear me clearly as well. Okay, thank you guys. So the first question is Nocturne Limited. So let's read the requirement first. Explain with the aid of the calculation supporting calculations which two of the proposed methods providing the laptop computer to JED would result in lower tax for Nocturne Limited. Okay. B. Explain the income tax implications for Siglo of providing the loan to Nocturne Limited. Okay, so there's a one character called Jed to whom the company is giving laptop, and there are two ways. And now there's an individual Siglo who's providing the loan to the company. Okay, so in C, determine by reference of the de minimis tests 1 and 2, Nocturne Limited's recoverable input VAT for the year ended 31st March 2021. Now guys, how many of you are aware about the de minimis test in the VAT? Raise your hands. Okay, only few students. Guys, it is very important topic. I'll revise with you shortly that what this topic is about. Let me read the last requirement. Advise Siglo of Nocturne Limited's eligibility for the annual test for the computing amount of recoverable input VAT for the year ended 31st March 2022 and the potential benefit to be gained from its use. Now, both of these topics, the de minimis tests and the annual tests, are correlated and they relates from VAT. Now, if you open my notes, I'll take you to my notes, and if you go into the chapter of VAT, that is the last chapter, there's a heading called partially exempt business. In partially exempt business, you'll find out that there are three types of tests. Now, what happens with partially exempt businesses? There are two types of sales in VAT: taxable sales and exempt sales. In taxable sales, there are further two types: standard rated and zero rated. On standard rated, you charge standard rate of VAT, that is 20%. In zero rated, you charge 0% of VAT. But on both, you charge VAT, and all of the overheads that you incur to make those sales, if you have suffered input VAT on them, you can recover that VAT as well out of the output VAT you receive in exchange of taxable sales. Now, what about the exempt supplies? If you are making exempt supplies, as obviously the name suggests that they are exempt from VAT, you cannot charge VAT on them. In exchange, all of the goods you purchase or all of the overheads you incur to make the exempt sales are also not recoverable. So what about a business who is dealing in both? He is dealing in standard rated or the taxable sales as well as the exempt sales. Now, obviously, if he is using the same building or the same office or same area, he will be unsure that exactly how much overheads he is incurring on the taxable sales or on the exempt sales. However, he can have a rough idea. For example, if he can check that how much of his turnover is comes out of taxable sales and how much from exempt sales, so he can have a rough idea that, for example, if somebody has 80% of their turnover from taxable sales and 20% of their turnover from exempt sales, so we can allocate that might be 80% of the overheads are being used in or incurred for taxable sales and 20% for exempt. So as the concept suggests that the overheads incurred for exempt sales cannot be recovered, such businesses are called partially exempt businesses which deals in both. And for them, what they will be wanting or needing is that, is there any possibility that they can recover the input VAT in full? That is for the sales that are exempt as well. Is there any possibility? And the answer is yes. There are tests called de minimis tests that a business needs to apply on their business before every VAT return. And if they succeed in any of the tests, they can claim the complete VAT. The one that relates to taxable supplies and the one that relates to exempt as well. So what are these tests? There are three tests and there is one condition. So condition means that the condition needs to be fulfilled before applying the test. If the condition does not get fulfilled, we will not be applying the test. So what is the condition? The condition is, guys, that 50% your exempt sales should be 50% or less than of your total sales. Again, exempt sales should be less than 50% of your total sales. So they cannot be more than 50% of your total sales. This is the condition. If you fulfill this condition, then we can apply the test, and if any of the tests succeeds or passed, you can claim the non-claimable input VAT as well. Now, what are the tests? The first is if your total input VAT for the year is less than 625 per month on average. If you multiply it by 12, it becomes 7500. So if the question has given you the data in the annual format, you can multiply this limit by 12. If the question has given you the data in quarterly format, you can multiply this limit with 3 to check whether you pass this test or not. So if obviously your total input VAT is more than 7500, you do not pass this test. In total input VAT, VAT relates to taxable supplies as well as non-taxable supplies includes. So now moving on, what is the second test? The second test is that total input VAT less VAT directly attributable to taxable supplies. What do we mean by VAT attributable to taxable supplies? That expenses which you can directly trace that you have incurred those expenses on taxable supplies. For example, I'll give you an example of a business who is partially exempt. For example, a college. A college deals in exempt courses as well and the courses that are taxable as well. Now, obviously, there is a chance that college might be using the same building for both type of the courses. So the overheads exactly incurred on exempt courses and the taxable courses are difficult to find out. However, the salaries that they are paying to the teachers who are teaching exempt courses and the taxable courses can be found out directly. The books, the materials, that have been bought for those courses, and all other expenses that can be directly traced and find out are called directly attributable expenses. And all of the expenses on which the input VAT is recovered can directly be traced that these have been suffered, this input VAT has been suffered on the items which are taxable or standard rated, not exempt. However, as I told you that, for example, there's the rent of the building, it cannot be traced that how much rent shall we attribute to the exempt courses and how much to the taxable. Now, what do? We normally calculate a percentage on the basis of sales, that if 70% of the sales is taxable, then 70% of the rent should be attributable to taxable supplies and 30% to exempt. So the input VAT suffered on the rent, 70% of it can be attributed to taxable supplies and 30% to exempt. But do remember that rent is not directly attributable. Give me a second, guys. Sorry for the interruption, guys. So I was telling you that the VAT that can directly be traced is called directly attributable, and that cannot be directly traced is called unattributable. So the second test is that out of total input VAT, you should minus the input VAT that is directly attributable to taxable supplies. If that answer comes at least 625 per month or 7500 or less for annual, then this test can be satisfied. And the third is that your total non-claimable VAT that relates to exempt supplies or whatever your total non-claimable VAT is, if that is less than 625 or less than 7500 per annum. For third test, the C1, you have to make this table, but for the first two tests, you do not have to make this table. So for this first two, what you'll do is the total input VAT will be given to you in the question, and the total VAT that is directly attributable to taxable supplies will be given to you in the question as well. The total VAT that directly attributable to exempt supplies will be given to you in the question as well. But for overheads, the VAT you have to apportion yourself. And how do you apportion the input VAT on overheads? The formula I told you that if 70% of the sales relates to taxable supplies, 70% will be rated as claimable and 30% will be non-claimable. So in non-claimable section, only two figure comes: exempt supplies, or the input VAT relates to exempt supplies, and percentage of the overheads that relates to exempt supplies. So you make this table only and only if the question tells you that you have to conduct all three tests. If the question tells you that you have to conduct only the test one or the first two tests, then you do not have to make this table. So do remember that. Now, before I get back to question, raise your hands that you have understood. Okay guys, if you have any question, you can put in the question section. However, when I'll discuss the question with you, the topic becomes more clear. Now, what about the annual test? These tests that I have told you, you have to conduct them before every quarter. Or if you are in a monthly arrangement with HMRC, then every month. Annual test is such a test that after which, if you qualify for which, you do not have to conduct the test every quarter, and rather you just have to conduct the test once in a year. And if you pass the test, till next year you can claim your complete input VAT. So that is the advantage of annual test. But there are certain conditions to qualify for annual test. And what are these? In my notes under the de minimis limits, I have mentioned them. That is, The business can apply the de minimis tests once a year rather than every return period if the business was de minimis in the previous year that you have consistently applied the de minimis test. The annual test is applied also consistently throughout the last year, and your total input VAT this year, total means VAT from all sources, shall be less than 1 million. If you satisfy all three conditions, HMRC will allow you to conduct the test once a year rather than every quarter. So this will save administrative cost as well as time as well. Now, let's get back to the question. All we have to do now is to read the question and relate the guidance with the scenario. Nocturne Limited is a partially exempt business which we were expecting anyways. Otherwise, why would we have to apply the de minimis test? For the purpose of VAT, it requires advice on the CT implications of providing an asset to its shareholder, the income tax implications of another shareholder making the loan to the company, and simplifying the way in which it accounts for VAT. Nocturne Limited is a resident trading company, prepares accounts 31st March annually, has 4 shareholders, each of whom owns 25% of company's ordinary share capital, which means that Nocturne Limited can be classified as a closed company. Now, I'll remind you what is the closed company. A company in which the majority of the control is with 5 shareholders, and if more than 5 shareholders, then all should be directors. This is the key concept. Here you can see that 4 shareholders are controlling the company. Owns a laptop computer which it purchased on October 2017 for 1200. So the company has purchased this asset back in 2017 for 1200, and which has a current market value of 150. Okay. Own He purchased no other plant and machinery for several years, has purchased no plant machinery for several years, and the tax written down value of its main pool at 31st March 2021 was nil. That's fine. Provision of a computer to one of Nocturne's limited shareholders. Nocturne Limited is considering 2 alternative ways to providing a computer in this year ending to one of its shareholders, Jed. Jed is neither a director nor an employee of Nocturne Limited. So guys, I'll stop here and ask you that if the person is not a director, only shareholder, means not a director or employee, but only shareholder, can we provide him any asset? Just answer me in yes or no. I'm not asking about tax implications. Can we provide him any asset as a company? Okay, thank you, Bella. Rubina, we can. We can provide him the asset. However, the tax implications are different if he would have been a director or employee along with the shareholder. But if he is only a director, if he is only a shareholder, not a director employee, we can give him the asset. The asset is allowed in both scenarios. However, tax implications are different. Now, if he would have been an employee, it's obvious that it will be a taxable benefit in kind for him. But as he's only a shareholder, you're absolutely right, Fahim Feroz Ali, that it will be treated as a distribution of profit. Yes, Bella, you're right. The appropriate word will be distribution of profit, which in easy terms obviously means dividend, Feroz. Because what HMRC is trying to combat here, that let's say, Fayaz, that if I have to buy a motorcycle and if I take out the dividend from the company, I first have to pay the tax on that, and then out of that money I'll buy my motorcycle. But one person thought, wouldn't it be better if I ask company to take the motorcycle on my behalf and they just give me the motorcycle? In that way I'll be able to get away from the dividends income tax, and as I am not employee, it will not be a tax benefit for me as well. So to combat that thing, HMRC said that if only shareholder is trying to get anything from the company, apart from dividend, we will treat that as dividend. Be it a loan, if even if he will be taking a loan from the company, the HMRC will consider it as a dividend, but obviously it is a possibility that the person might be taking the loan for genuine purposes. So in that case, the rule of HMRC is a bit different, which we'll be studying in a moment. There's a question on that today, so when we'll be doing that question, we'll discuss this part there. That what happens when a shareholder takes a loan from the company. Now, so you guys are right that it will be treated as a dividend. So now let's see that what are the other details. Option 1, Nocturne Limited will buy a new laptop of for 1800 and give it immediately to Jed. So I'll stop here and I'll analyze this option. I've told you in, I guess, either yesterday's lecture or before that, that if a company buys any asset for the lap for any shareholder, I guess there was a person in the question for whom the company was buying motorcycle. I can't remember exactly what question it was, but I told you there that what happens is that if company buys an asset not for their trading purposes, rather for one of their shareholders, the disadvantage to companies that they are unable to claim any capital allowances on them. So one disadvantage for the company. For the shareholder, it will be treated as a distribution of profit, which means as a dividend, and he may have to pay the tax on that. However, as he is not the employee of the company will not have to pay class 1A NIC on that, because if he would have been an employee of the company and the company was to provide him this laptop, the company would have also had to pay class 1A 13.8 NIC. In this case, because of him not being an employee, the NIC will be saved. However, there will be no capital allowances or loss of capital allowances for the company. And for JED, it will be treated as a dividend. So that is our in option number 1. In option 2, Nocturne Limited will gift its existing laptop to JED and will purchase a replacement for use in the company of for 1800. Now, what will happen in this option? That Nocturne Limited will gift the old laptop to JED, not the new one, and the new one they will buy for themselves. Now, in this case, as they are buying the asset for themselves, the new one, they will be able to claim capital allowances on 1800. It will qualify for AIA. So 100% capital allowances at the time of purchase. So on 1800, there'll be a 19% corporation tax saving. Okay. But the laptop that they have given to JED will be considered as a disposal from company's point of view. And if you remember that in the start of the question, it has told us that the current value of the old laptop is 150. There you can see. So we will consider that we have sold it on its market value to JED. Now, as it is a depreciating asset, on the disposal of that, balancing charge or balancing allowance will arise. So I need to know what is the written down value of the laptop to confirm whether a balancing charge or a balancing allowance arises. So guys, if you see, it is mentioned in the question that the value of my tax written down or main pool is nil. So asset was basically in my records was worth 0 and I have sold it on 150. So guys, a balancing charge will arise or a balancing allowance will arise. You're right, Johannes, balancing charge. Thank you. So in one case, the company will be making savings, that is taking 100% capital allowance on 1800. However, on 150, they will have to pay the tax. So 150 will decrease their capital allowances and 1800 will increase their capital allowances. So net effect will be 1800 1800 less 150. That is 1650. And on 1650, the company will be making 19% tax savings. That is 314. So 314 will be the company's savings. Now let's read the requirement again, that what has been asked by me. Explain with the aid of supporting calculation which of the two proposed methods of providing the laptop would result in lower after tax cost. So whatever the tax savings are, I have to deduct it and then tell that which one will result in lower after tax cost for Nocturne Limited. So I'll use the spreadsheet to show you guys quickly that how you can present that. You can write option 1 on one side, option 2 on the other. You can write cost for the company, that is in option 1 the company will it will cost company 1800, and then you can write tax saving. In option 1 there will be no tax savings because the company has bought the laptop and given it to Jed straight away, so no capital allowances, so no tax saving to company. So cost will be this 1800. In second, the cost will obviously be the same because the laptop will be the same in both options. However, as we have calculated, the company will be able to make 314 of tax savings. And you guys know how this 314 has been calculated. The difference between balancing charge and the capital allowance and times into 19%. So guys, you tell me here, which option results in a lower after tax cost? Thank you. So till here, option 2 results in lower tax cost. Thank you. Now, I'll tell you that this can be a base for you, that it is very common in real life and as well as in your ATX exam, that the clients come and they have already few suggestions in their mind. They tell you their suggestions and ask you to compute that in which option lower after tax proceeds or higher after tax proceeds, lower after tax cost or higher after tax proceeds will result. Because if they are proceeds, so they will be concerned in which option there will be higher after tax proceeds. If there is cost, they will be concerned in which option will result in lower after tax cost. So this format is not compulsory. You can make whatever format you want to. For example, if you think that you can show this calculation by writing a paragraph and in between you can show these calculations as well, it is perfectly fine. Now, but after this making this calculation, you can show this calculation you're working, but you have to explain. Do remember that I always tell you that imagine that the client is sitting in front of you. If you calculate this and present this paper to him, he'll not even have a clue where does this 314 comes from, what is this 1650 in one option, and why there is no saving in option A. So you then have to explain him that because you are a closed company and you're not even a director of the company, so providing you the laptop will result in considered as a dividend distribution. On that, company will not be able to claim any capital allowances. However, if company provides you the old laptop and buys new one for itself, it will be able to claim the capital allowances on the new one. However, there will be a balancing charge on the old one, but despite of that, there will be a corporation tax savings of 314, resulting in overall after tax cost of 1649 or 1486. Therefore, option 2 will result in lower tax lower after tax cost for you. So in this way, you have to explain him, and do remember that the client is sitting in front of you, but you are not allowed to talk. The only way of communication is paper. So that is how you should answer. Now, moving on, explain the tax implications of Siglo providing a loan to the Nocturne Limited. So let's read about the loan. There we can read loan from Siglo. Siglo will loan 60,000 to Nocturne Limited on 1st October 2021 to facilitate the purchase of a new equipment. Seglo is both the shareholder of Nocturne Limited and the company's MD as well. So now, do remember that he is not only a shareholder, he is an employee of the company as well. Nocturne Limited will pay the interest to commercial rate on the loan from Seglo. Seglo will borrow the full amount of the loan from the bank on normal commercial terms. Now, what is happening here? Rather than employee or shareholder taking the loan from the company, he is rather giving the loan to the company. Okay, the company will be paying him the interest, and he will paying the interest to bank because he does not have the money on its own. He'll be borrowing the money and then giving it to the company. Now, we'll take one by one. You tell me, if the company pays him the interest, will it be a taxable income from him? This interest will be taxable in his tax return, yes or no? Yes, it will be a taxable income for him in his savings income. And if he's a basic rate band payer, then first 1000 will be at 0%. If higher, then 500. If additional, then no savings band. Thank you. Now, in second option, in second part, he is buying the loan from or taking the loan from the bank and then giving it to the company. Now, there's a relief called qualifying relief. Do you think that this loan will be a qualifying loan? Yes, because one of the criteria is that if you borrow the money to invest either in partnership or in a company. So this loan has been specifically taken to invest. Therefore, what he can do is Seglo that on his tax return he can deduct the interest of the loan considering this as a qualifying loan. So the interest from Nocturne will give rise to the taxable income. However, the one that he'll be paying the bank can be deducted as a qualifying interest and will result in tax savings. So that is how I will explain him, considering that the Seglo is sitting or I am writing a letter to Nocturne Limited about the implications. I will explain in such a way. Now, lastly, guys, let's talk about VAT partial exemption, about which have I recently told you. So I'll read the requirement and we'll come back again. Determine by reference to the de minimis test 1 and 2 only. Nocturne's Limited's recoverable input VAT for the year ended 31st March. So we'll not be conducting the third test for which we have to make the table. But if you read the examiner report, he was very annoyed because many of the students have wasted their precious time and made the third table where this was not even asked or required, and they have not even scored any marks, rather lost their precious time in the exam as well. So be careful. Now let's read about its VAT position. Nocturne is a partially exempt business. Nocturne's turnover for the year ended is 240, VAT exclusive. So the VAT is not included in that. Nocturne's turnover for the year comprises of 86% taxable supplies, 14% exempt supplies. The input VAT suffered by Nocturne Limited on expenditure during the year ended. These are the input VAT position. So the wholly attributable to taxable supplies is 7920, to exempt supplies is 10662, and that is unattributable is 4150. To attribute this unattributable, what you will do is You'll take 86% of that and include it in claimable section and 14% in non-claimable, but that we only do if we had to make or perform the third test and make the complete table. Now, first of all, for first test, that is, if your total input VAT is 625 per month or lower on average, or annually 7500. So I don't think so, because only the attributable to taxable supplies is higher than 7500. But still, to show the examiner, I have to calculate the total amount of input VAT. That is 7920 plus 1062 plus 4150, 13132. So obviously I'll tell examiner that because the total input VAT is more than 7500, it does not pass or satisfy the test 1. But even before that, I'll write and say, to apply the de minimis limit, there is a condition that your exempt sales should be less than 50% of the total sales, which is satisfied because Nocturne Limited has only 14% of the exempt sales. And then I'll perform this calculation and explain that test 1 is not satisfied. Let's talk about second test. Total input VAT less VAT directly attributable to taxable supplies. Whatever your answer is, if it is less than 7500, then the test 2 is satisfied. So I have total input VAT here calculated already. I'll just deduct the VAT attributable to taxable supplies out of that. 5212, which is less than 7500. So the test 2 is satisfied. So even if the question would have asked me to perform all 3 tests, I would not have performed the test 3 because test 2 is satisfied. So there is no point of performing test 3. So do remember that as well. Now, with that, we have summed up till here. And as far as the last part is concerned, so I have already told you that what will be the advantages of annual test. Nocturne Limited will not have to conduct these tests every quarter. Rather, they will conduct the tests annually. However, there are certain conditions which we have just discussed before starting the question. So guys, till here, raise your hands if you have understood. Thank you. Now, a short 5-minute break and then we'll start our next question. Okay, guys. So let's start our next question. Raise your hand and give me a go ahead. Thank you. The next question is Club PLC. It is from December 14. So let's read its requirement. State the corporation tax returns required from Club PLC in the respect of the 16-month period ended 31st March 2020 and the due dates for filing them. So guys, you tell me after the relevant ending account, period of account means for which we prepare the account. After how many months do we have to submit the corporation tax return? In question section. How many months? Now, Johannes, do remember in 9 months and 1 day we have to submit the accounts and our tax liability. However, to submit the return, we have more time available. That is 12 months. So by 9 months and 1 day, the tax payment needs to be made. Now you'll be like, sir, if we have not prepared the tax return, how can we make the payment? I mean, why HMRC has provided us less time for payment and more time for return? HMRC says that normally one should calculate and prepare the tax return by 9 months. However, if they are unable to due to some reason, they shall submit the estimated liability to HMRC, and then later on, between the next 3 months, they can pay the actual one. So that is the purpose. So don't get confused. To submit the return, we have 3 more months. That is 12 months to be complete. However, to submit the payment, we have 9 months and 1 day. And that is too for the 9 months and 1 day, that is for the small companies. For large companies, they normally pay the payments as well in 4 equal installments. Okay, guys. So state the corporation tax returns. We can now tell that the corporation tax return should be 31st March 2021. However, explain the penalties which may be charged in respect of the late filing of these returns. That I have to read the question to see. Because the penalty depends on how much late you have submitted the return. Within 3 months, 3 to 6 months, more. So it depends. So I have to check. Compare and contrast the tax advantaged share incentive plan with a tax advantaged company share option plan. So share incentive plan, that is SIP, which is an HMRC's approved incentive plan, and one of the approved share option scheme, CSOP. We have to make the comparison. On what basis? The flexibility desired by the club PLC. Okay, so we'll be telling that which one is more flexible, and the club PLC will tell us in the question what kind of a flexibility they are talking about. Regarding the employees included in the plan and the number of value of shares which can be acquired by each plan member. Okay, and the number of shares in which scheme, how much members or value can be given to the shares. Okay, fine. The income tax and capital gains tax implications of acquiring and selling the shares under each plan. So I also have to tell that what are the income tax and CGT implications of acquiring. If we have we have done a question in yesterday's lecture or a day before about the share option plan in which there was an EMI, and in that I told you that for approved share option schemes there are no tax implications on grant date and even on exercise date. The only implications are on disposal date. So we'll discuss about SIP as well, and we have already discussed EMI. Today we will discuss CSOP as well, CSOP, company share option plan. In C, explain whether or hard score will be regarded as a CFC. for the year ended 31st March, excuse me, 2022, and the availability or otherwise of the low profit exemption. So we have discussed what CFC is in yesterday's lecture as well. Today we have to tell here that whether or not the company will be regarded as CFC. The first criteria is obviously if the company is being owned more than 25%, and the second criteria is if the profits are being artificially diverted from that company to UK. If these two conditions gets fulfilled, it can be regarded as a CFC. However, out of many exemptions, with the help of which, despite of being the above two conditions, you can get away from the CFC charge, one of the exemption is a low profit exemption. We'll discuss in a bit that what that exemption is. And then we'll compare it in the questions data that whether the CFC charge will be applicable or not. On the assumption that Hardsco is a CFC, that no CFC exemptions are available, the budgeted CFC charge for Club PLC based on the budget results for the year ending 31st March 2020 needs to be calculated. So guys, this question will cover few key concepts, that is when to submit the tax return. So I've cleared the confusion between 9 months and Monday and the submission of tax return. The second will help us to revise the company's share option plan, CSOP and SIP, share incentive plan, and the third will help us to revise the CFC. Now let's start the question, but before that, excuse me for 2 minutes please. Sorry for the interruption guys. So let's continue. Club PLC, a client of your firm, requires advice on the penalty in respect of the late filing of the corporation tax return, establishment of an approved tax efficient scheme, and its shareholding in an overseas resident company. Club PLC is a UK resident trading company, has been charged the penalty in respect of late filing corporation tax returns, intends to establish a tax advantage share plan, purchased 30% of the ordinary share capital of Hardsco from Mr. Deck on 1st April 2021. Okay, so we now know that what is Hardsco. Hardsco is a company for which Club PLC has bought 30% shareholding. So the first condition of CFC, that the ownership should be at least 25% or more, is satisfied. Late filing of corporation tax returns. Club PLC prepares the accounts for the 16-month period 31st March 2020. The corporation tax returns for this period were filed on 31st May 2021. Always, before considering that what the penalty is, you should first determine that what should be the actual date. The actual date from the exact 1 year of the 16-month period should have been 31st March 2021. So now you have seen that the return has been submitted after that. The return has been submitted after 31st March 2021. Now, the next thing you have to determine is how much late the return has been submitted so that you can confirm that what penalty should be charged. In my notes, in corporation tax, there's a section called administration that is in the very start, and that tells you different things. For example, late return penalties, if it is within 3 months, 0 to 3 months, it is a fixed 100. Then within 3 to 6 months, it is £200. Then for 6 to 12 months, 10% of corporation tax, and then so on. So now you tell me that in our question, what shall be the penalty from the table that I have shown you on the screen? Fahim Feroz, yes, unfortunately, you have to learn all the penalties. Thank you, Fawad. 100 is the correct answer because it is within 0 to 3 months. The actual date was 31st March. Until 30th June, if the return has been submitted, the penalty should be 100, and the return has been submitted by May. So the answer is 100. But how will I explain it? I will explain that the club PLC have made the period of account more than 12 months. It will split in two accounting periods, that is one for 12 months, one for 3 months. So the 12 month will end at 30th November 2019, and the remaining 4 months will end at 31st March 2020. So one 12 months, one 4 months accounting period. Then the appropriate or the deadline for submitting the corporation tax return was 31st March 2021, as the company has submitted the tax return within 3 months late. £100 penalty will be applied. To remember, guys, if the companies keep submitting their tax returns late, after 3 years, the HMRC replaces the £100 penalty with 500. That is what you call persistent penalties. Persistent penalties means that the company is being consistently, regularly late. So the HMRC only for them have replaced this £100 with £500. But it is not mentioned here that the company has submitted returns late for the third time. So if it were mentioned that the company has submitted the return for the third time late, we will replace the 100 to 500. I hope it's clear. So let's move on to the second part. Approved tax efficient plan. The plan will either be a tax advantage share incentive plan or the tax advantaged share option plan. If a SIP, the shares would be held within the plan for 5 years. If a SIP, members will not be permitted to reinvest dividends in order to purchase further shares. If a CSOP, the shares would be exercised within 5 years of being granted. In both cases, it can be assumed that the plan members would sell the shares immediately after acquiring them. Now, I will stop here and I will take you to my notes to tell you where you can find CSOP and SIP in there. In income tax, you can find CSOP, SAY, that is save as you earn, and EMI. All these three are approved share option schemes. Share option schemes means company will promise you that they will be giving you the shares at a predetermined price at a future date. Now, every scheme has their own criteria, advantages and disadvantages. And what is SIP? SIP is a share incentive plan, an approved share incentive plan by HMRC. What happens in SIP? The company provides you free of cost shares, and you can submit some amount of your salary to the company to buy a few shares more. The free shares that a company can grant you can maximum be up to 3600 of the value to each employee each year. The employees can buy further shares, but that depends upon what is their limit. Maximum of either 1800 or 10% of their salary. They then can buy again, or employee may then choose to issue further shares. These are called free matching shares, but their proportion is fixed. They will be 2:1 on the basis of your partnership shares. So obviously, first there'll be free shares. The second step will be, if the company wishes or the employee wishes, will be partnership shares, and then there will be free matching shares. What are the conditions? Plan must be available to all of the employees or can be group of the employees as well. Plan must not have any arrangements for the loans, and for the tax-free advantage, share must be held in the plan for 5 years. Now, what do I mean by that? I'll take you to their tax implications. If the shares are held for complete 5 years, there will be no income tax and NIC implications. And whenever you sell them, you have to pay CGT, but the CGT will be market value at the date of disposal, and your cost will be market value at the withdrawal date on which you have withdrawn the shares from the company. But it will be out of the scope of income tax and NIC. And do remember why it is always beneficial to be stay out of scope of income tax and NIC. Because if you're a high rate band payer, it may cost you up to 42% of whatever your benefit is. However, in CGT, not only you have annual exemption available, not only you have on certain reliefs available, but the highest tax rate can be as max as 20%. So it is always beneficial that even if you're getting taxed at anything, CGT is a better tax, because in that rate of taxes are lower. That is why in all of the approved schemes, you cannot get away from the tax altogether, but you can see that at least there are no income tax implications. That is if you held the shares in the plan for complete 5 years. And I will discuss this because it is mentioned in the question that I have to discuss the income tax and CGT implications. However, I will relate this because it was mentioned in the question that if the company will opt for a SIP, the employees will keep the shares for 5 years. Now, the other extreme, if they keep it for less than 3 years, then whenever they withdraw, there will be amount chargeable to IT and NIC, and that is whatever the market value at withdrawal date, that will subject to IT and NIC. However, there is an in-between scenario that if they keep it more than 3 years but less than 5 years, the IT and NI will still be applicable. However, it will be lower of market value at the grant date and market value at the withdrawal date. So if the company's share have increased over the years, obviously the grant date will be lower. So you'll be subject to ITNI but at a lower value. And CGT in all three cases needs to be paid. Now, let's get back to CSOP, that is an approved share option scheme like EMI. This table can tell you the comparison as well. In CSOP, you can provide the share options, that is a promise, to a selected group of employees. And here, the value for which the shares can be given are way more than SIP. That is, you can give up to 30,000 per employee. However, there you can't give more than 3,600 free shares. Then there is a very low limit to buy partnership shares and then free matching shares as well. Here, the employee can be either full-time or part-time. If there are directors can be full-time. If not, they should be working at least 25 hours of the company. Employees have already more than 30% holding cannot participate in this, and options should be exercised within 3 to 10 years. But you are not supposed to tell conditions here that I am telling you for your concept. You are only have to tell about the flexibility, and the flexibility deals with these 2 points and the tax implications, which is this. And as for all approved schemes, no ITNIC implications at grant date and exercise date. The only tax implication will be at capital gains tax, that is on disposal. And I have made a table in start, which I showed you when we were studying EMI as well. So do remember, only in only scenario that an approved option scheme can be taxed at a grant day exercise date is that if it is an EMI scheme and the shares have been granted at discount, and that particular scenario we have discussed as well. Now, moving back to the question before that, if anybody has any question, they can ask. Okay, guys, I'll move back to the question. Now, what will I tell company here? I will give a heading that Club PLC wants the share plan to be flexible in terms of the employees who can be included in the plan. So I'll give this heading, under that I will discuss the flexibility of both, and I'll tell that in CSOP the share scheme can be given to complete or the selected group of employees. The number of value of the shares which can be acquired by each plan member. In CSOP, it can be given maximum up to 30,000 per employee. However, in SIP, the option can be given to selected or all of the employees. The maximum value of free shares is up to 3,600. However, the employees can buy later on the partnership shares, that is lower of 10% of their higher of 10% of their salary, or 1,800, and then they can buy free matching shares as well in proportion to 2:1. So that are 2 points that I've explained for both. Now, as the question asked me to tell the tax implications as well, I will here also explain the tax implications that I have discussed with you regarding the ITNI for both and CGT implications for both. So till here we have discussed the corporation tax dates and the share schemes. So we are only left with the CFC part now. Hertzko is a resident in the country of Suta. Mr. Deck continues to own 25% of the company's ordinary share capital. Kotko, a company resident in the country of Suta, owns the remaining 45%. So Mr. Deck has sold us 30% and he still owns 25%. That doesn't matter. Kotko, a resident company in the Suta, remains the remaining 45. Budgeted results are trading profit of 330, chargeable gains of 70,000. All of the Hertzco profits have been artificially diverted from the UK. So that you can see as well. That is another condition. Hertzco will pay corporation tax on the rate of 11% in the country of Suta and will not pay a dividend. Now let's visit our notes and visit the CFC section, where I have explained the exemptions to the CFC as well. What is CFC specifically, that I have told you in the yesterday's lecture. I'll go to the exemptions. So there are many exemptions. Exempt period, that the first 12 months is exempt period. Then the HMRC has provided the list of excluded territories. Then low profit exemption. Here we have specifically been asked to apply the low profit exemption. So I'll only consider and discuss the low profit exemption here. The low profit exemption is if the company which is regarded as a CFC, its total taxable profits are less than 500,000 and out of which the non-trading profits should not be more than 50,000. Non-trading profits mean that the income from other sources should not be more than 50,000. So both conditions need to be met. So let's get back and see that what is happening in our question. The trading profits are 330. However, the chargeable gains are 70,000. Now guys, you tell me, can it qualify for the low profit exemption? The first condition met, that is the total taxable profit are less than 500,000, but the problem is non-trading profits, that is chargeable gains in this scenario, are more than 50,000. So the problem is it does not qualify for low profit exemption. So the question has asked me that whether it will be regarded as a CFC. So I will tell that as we own it more than 30% and the profits of it are artificially being diverted from the UK, so it will be regarded as a CFC in the absence of any exemption. First thing. Then I'll tell that it will not qualify for a CFC low profit exemption because its chargeable gains are more than 50,000. Now, moving on, in the last part, I have to calculate that assuming if the company is a CFC and no CFC exemptions are available, I have to calculate the CFC charge based on the budgeted results. So we have the data available here, guys. I would rather request you, and I'll provide all of you 2 minutes that you calculate yourself and post your answers in the question section, and then I will solve with you as well. So I'll be waiting here for your answers. Guys, no answer I have received. I like I will solve myself with you guys, but I was expecting at least 2 3 answers. Not that difficult. All you have to do is that you first have to see that how much profit belongs to us. So the total profits, you can say that club share is out of total profit is 30%. So 330,000 times 30%, that will be 99,000. So the CFC charge will be on 99,000. What is normally CFC charge? CFC charge is that you should consider that corporation tax will be applicable on these profits. However, DTR will still be available. In my notes, you can see that how to calculate a CFC charge as well. And at the end, I have provided a formula. There you can see. So I'll get back and write here that CFC charge is this. Sorry, this is the share of profit. Now I have to calculate that what will be the corporation tax on these profits if they were taxed in UK. And that will be simple. Take 19% of that. 18180 will be the tax that would have been payable in UK. Now, as DTR is available, so you will deduct the tax that is payable in the country of SUTA. So we'll see that what is the rate. It is 11%. So DTR will be, because the lower rate is obviously in country of SUTA, so DTR will be 99,000 into 11%. That is, so the CFC charge will be this minus this. 7920 will be your CFC charge, guys. Now, raise your hands if you've understood how I have calculated the CFC charge. It's simple as that. All you have to calculate is that what will be the corporation tax in the UK less the DTR. Thank you. Thank you. Thank you. Okay, guys. With that, I have summed up another question. So we'll move on to the third question. And the third question I have is for you. It is available on the practice platform. It is from the latest attempt, that is the September-December 2020, from which we have yesterday done Lamar question. So the latest attempt can be found in the CBE practice platform. It is the last question. This one. The name of the question is Dorian and Tupe Limited. So you have been asked to provide advice to Dorian, the managing director of T Limited, in relation to T Limited status as a closed company, the company's provision of employment benefits to D, and the late filing of the company's corporation tax return. So these are the three methods. Again, we have done a similar question in which there was a company's provision of employee benefits to a shareholder. Then there was a corporation tax late return penalty as well. So we'll see that what are the information that is given to us in this question. So we'll start with the requirements. They will merely telling us the marking scheme. Explain why T Limited classed as a closed company. That's fine. Explain with supporting calculations the tax implications for both Dorian and T Limited if D repays the 7500 loan on 30th April 2022 rather than 30th June 2022. So we have to see that what kind of a loan we are talking about. But what I know is that what if he repays the loan earlier? What is the impact of that? Explain the supporting calculations, the which of the two alternatives for providing assistance with travel cost will provide the lower overall cost of Dorian. Again, we have to tell that out of two alternatives, which one will result in lower cost. So let's read the question now. T Limited is a UK resident company and is also a closed company. has 6 directors, Dorian and 5 other unrelated individuals, prepare accounts to 30th April each year, always pays all amounts due to HMRC by the due date, is not a large company for the purpose of being required to pay its corporation tax liability in installments. Now, T Limited shareholders, the shares in T Limited are as follows. D owns 5% of the shares, the other 5 directors each holding 5%. So including D and the other 5 directors, they have holding of at least 30% because 25% of theirs and 5% of D. Basil, D's father, owns 23% and other unrelated shareholders each holding less than 2%. So that makes a total of 100%. So guys, now if you know the criteria of a closed company, till here you can answer the question. So can anybody tell me why it can be regarded as a closed company? Anyone guys? I'll explain you in detail that what normally is the criteria of a closed company. A company is a closed guys if it is controlled by any number of shareholders who are directors. So control means that they must have the majority control. The problem here is that Dorian and other directors, including, are not controlling the company because they do not have the majority shareholding. So this criteria will not be applicable here. Now, I do not know that you know or that or not that if the 5 of the largest companies shareholders controls the company, then it can also be regarded as a closed company. So this is another criteria as well that you should remember. Then do remember that when HMRC looks the company as a closed company, HMRC does not consider only the person itself, but also the close associates are considered to be the shareholders as well. So close associate means direct relatives, in which do you think that his father will be qualified as a direct relative? Johannes, your answer is right that his father, the directors, and he, if we add all of their ownership, these guys are controlling the company. So the D and the father will be considered as single, that is 28%, 23% father, and 5% D. So they will be considered as single, plus 25% other directors. So by this, our answer will be 53%. I know it's a new concept. The examiner has never tested the closed company in such detail before, but it is an opportunity for us to learn it. Okay. So do remember that if the 5 largest of the shareholders are controlling the company, then it can be the largest company or any number of shareholders who are also directors. So here the directors themselves are not claiming controlling the large company, but if we add D and D's father shareholding in that, by making them or by adding their shareholding, they become the largest shareholders and hence are controlling the company. Now, raise your hands, guys, if you have understood here that why it will be regarded as a closed company. Now, getting back to the question, D has an annual salary of 78,000 from T Limited. So D will be a high rate band payer and NIC will be payable at 2% by him. Was provided with an interest-free loan of 7,500 from T Limited on 6th April 2019. So I know that whenever a company provides you an interest-free loan, a taxable benefit arises. So guys, do you think that here the taxable benefit will be arised because the company has given its shareholder and employee an interest-free loan? Yes or no? More answers, guys. So guys, we are wrong. The taxable benefit applies if the amount of the loan is above 10,000. I told you this a few days ago as well while telling you that always do remember that the taxable benefit arises if the loan is above 10,000. Here the loan is interest free but it is less than 10,000. It will not qualify as a taxable benefit for D. But you know what the problem is? If HMRC will not have some sort of a punishment on taking loan from your company, what you're going to do is you'll never take dividend, and whenever you have to take out the money from the company, you'll take it as a loan and will try to deceive HMRC. Oh, I'll repay it. I'll repay it. And company, what will gonna company do later on? They will gonna write it off. So to counter this, what HMRC has done it, HMRC says that whenever a company has to pay loan to their directors, they have to pay 32.5% of a notional tax of that amount to us as a security. If the director will actually pay back the loan to the company, we will consider that it is taken for the right reasons and they were not trying to deceive the HMRC. So what HMRC will gonna do is once you make sure that you have paid the money back into the company's bank account, they will return you this notional tax. However, if the company writes off the loan, the HMRC will keep that security that they have taken from you, the 32.5%, which is exactly the high rate of dividend tax, to themselves that your director has, that you have written off the loan of the director. So we will treat it as a dividend and we'll keep this tax. So that is why you call it notional tax. However, even this notional tax can be avoided by the company if the director and the shareholder has shareholding of less than 5%, first condition, and the loan provided to him is less than £15,000. If these two conditions gets fulfilled, the company does not have to submit notional tax to HMRC. Now you tell me, both of the conditions are getting fulfilled here or not? Not, guys, because he has exactly 5% holding and as per the rule he must have less than 5% of the holding. So that is why it is mentioned here that T Limited on that loan has given the notional tax to HMRC. Notional tax will be payable on this loan by T Limited. So T Limited will submit the 32.5%. And whenever the D will pay the loan back to T Limited, HMRC will return the tax. Now, D is planning to repay this loan on 30th June 2022, but it may repay it earlier, that is 30th April 2022. Has no other income, works full time at T Limited's office in London. Now, let's read the requirement again related to the loan so that I can confirm that what do I have to answer from the loan requirement. I've explained why it is a closed company, so that part is done. Explain with supporting calculations the tax implications for both D and T Limited if T repays the 75,000 loan on 30th April rather than on 30th June 2022. So I not only have to explain the the tax implications, but also have to tell that what will happen if the company will pay it earlier. As far as the tax implications are concerned, guys, there will be no tax implications for Dorian because the loan is less than £10,000. For T Limited, as I told, that there will be a 32.5% notional tax that they have to submit it to the HMRC. Now, what happens is whenever you repay the loan back to your company, you notify HMRC and HMRC returns you your money in 9 months and 1 day after the end of the period in which you have notified HMRC. So now you tell me what will happen if he will repay earlier and what happen if he will repay the loan late. Tell me in the question section. So guys, what do you think? What I think is obviously, yes, you're right, Johannes. If he will repay late, HMRC will no late payment penalty, Johannes, because it is the discretion of yours that how much long do you want to take to pay back to your company, because HMRC is not concerned because they have that 32.5 security as a notional tax. So they're not bothered whenever you pay them back. It's you that who should be bothered, because if you pay late, your money that you have paid to HMRC as a security will be recovered late. If you pay it earlier, the money will be recovered earlier because it will be 9 months and 1 day from that date when you will submit it to HMRC. Okay. Now, so this is the justification of on the supporting calculations that what will be happening. So till here, any issues? Okay, guys. Now let's move on. And the last part is I have to tell about two alternatives for which the travel cost will produce lower cost for Dorian. So let's read about those alternatives. T Limited assistance with D's home to work travel cost. Before that, I will tell you that home to work travel cost is not considered as performance of duties. So if your employer is paying for you that these costs, it will be a taxable benefit in kind. If you travel from your office to your temporary place of work or to meet any client and comes back from there to office, this commute will be considered as a work travel, and for that your employee can compensate and it will not be a taxable benefit as long as if he pay you less than the statutory mileage allowance or up to that amount. But if he pays you to come from work come to work from home, this will not be regarded as a business traveling, so it will be a taxable benefit. You should keep in mind in both alternatives. On 6 April 2021, T Limited will make an interest-free loan to D of 4,800 equal to the cost of his annual travel season ticket. Okay. T Limited will write off this loan on 5th April 2022 and Dorian will incur no additional travel cost under this alternative. Now, you tell me guys, what will be the tax implications of this alternative? First, do remember that they are again providing him the interest-free loan. Now, if they provide him this interest-free loan, his taxable limit or the exempt limit of 10,000 will exceed. You remember that he has already taken 7,500 loan in part A. Now, if the company will give him this loan, his 10,000 exempt limit will be breached. And because of breaching that limit, all of the loan will become a taxable benefit, and we have to calculate whatever the taxable benefit is, and it will be added into D's salary, and 42% tax will be payable on that. 40% tax and 2% NI. But on benefits, NI is not applicable, only tax is applicable. So that is why I'll be taking 40%, because on non-cash benefits, no NI is payable. Rather, you only have to pay income tax. So to calculate the loan benefit, we normally use two methods, that is accurate method and the average method. However, it is obvious and it is mentioned by HMRC that if you provide loan to your director, the benefit will be calculated using the average method, not the accurate method. However, do remember HMRC reserves the right to impose the accurate method if they find out that the repayment terms are not commercial, that is, you're trying to deceive us or deceive HMRC. Okay, so what will happen is, obviously, if he will get this 4500, on top of that 7500, 4800, sorry, on top of that 7500, 7500 plus 4800, this will be 12,300. 12,300 divide by 2. Why I'm dividing it by 2? To take out the average. As you guys know that we have to calculate the benefit using the average method, and will then multiply it by 2.25%, which is the HMRC's official rate of interest. This is the opening balance and this is the closing balance. Considering that 7,500 has been paid off. If not, what we're going to do is we'll take the complete loan amount, that is 7,500 plus 4,800, and consider that there'll be a 2.25% interest charge, 0.0225, because the rate has been reduced by HMRC from 2.5% to 2.25 in this Finance Act. So you have to remember that. So the taxable benefit kind in this scenario will be 276. On 276 or 277, if we can take it to be precise, 40% tax will be payable. So because of this, 1110 or 111 will be the income tax addition into D's liability. Again, try to understand what is happening here. Before, he has already received a loan from a company that is for 7,500, which was less than the exempt amount, so no taxable benefit. However, if he received this amount as a loan again as well, all of his loan benefit will become taxable into his salary, and the benefit is calculated on the interest, and the interest rate of HMRC is 2.25%. So I've calculated the interest, and on that I have taken 40% as a tax, because if that benefit is added into his income, it will increase his income by 277, and therefore his tax liability by 111. So this is the cost if alternative 1 will be selected. Now, in alternative 1, the company will later write off this loan. I told you in the last part that whenever the company writes off a loan to a director, it will be treated as a dividend. Now, if the company will do this here as well, this 4,800 will be treated as a dividend and will be added back into the D's income as a dividend and will be taxed at 32.5%, considering he's a high rate band payer. However, if you remember to include, you can discuss that first 2000 will be taxed at 0% and the remaining will be taxed at 32.5%. However, if you forgot, you lose 0.5 mark or a 1 mark for that. However, you'll score the remaining marks by telling that if the company writes off, because the company is planning, obviously the company is trying to give him the money, so he'll not be paying back for this traveling cost. So the company will obviously write it off. So if the company write it off, it will be treated as a dividend. So what will be the dividends tax? Let's calculate that because this will be added into the cost. So the dividend will be 4800 less 2000, so 2800. On that there will be a 32.5 tax, so 0.325910 plus 111. So D will be affected by two ways. If he will accept the alternative one, the loan benefit and the dividend tax. So the total cost to him will be 1021 for this. Now, if he accepts the second alternative, that is T Limited will pay D a mileage allowance for driving his own car to work amounting to 3600. T Limited will pay an unconnected company an annual fee of 1200 for a parking space for Dorian near the company's London office. Do remember to pay parking fees of an employee near the office is an exempt benefit. So if it pays this amount to it, it will not add any cost into Dorian's tax liability. This is an exempt benefit. Dorian has estimated that his annual or current cost of driving from home to work is 5220. It includes 1320 as a parking. So now if he'll be getting this mileage allowance of 3600, out of that, now 5220, the company will be paying his parking fee now, so he will not have to incur the parking fee, so let's deduct that. On top of that, the company will pay him the 3600 pound as well. So he will just have to incur 300 pounds from his pocket. That is one cost that he has to incur. Secondly, I have told you guys that if the mileage allowance is provided for the commutation of home to work, it is not regarded as a business commutation, so it will be a taxable benefit in kind. So on this 3600, 42% of the benefit will arise, that is 40% the tax, 2% the NIC. Now here the cash benefit is being given, that's why it will subject to NI as well. If you would have calculated 40%, you would have lost 1 mark but have scored the remaining marks. So let's calculate 42%. So 3600 times 42%. It's 1512. 1512 will be the tax. On top of that, he has to bear 300 from his pocket. That is 1812. 1812 in this option and the option before 1021. So 1021 versus 1812. Alternative one will cost Dorian the less or the two guys? You tell me. I know Rubina it's confusing, but you should remember the easy points. That is, obviously, if you will have more loan from the company, you will breach your 10,000 limit. And once you'll breach your 10,000 limit, it will be added into your income as a taxable benefit. You have to pay 40% tax on that. So that part you can remember. Then when it comes to alternative two, you should know that employee parking fees are exempt benefit. It should not be added. and mileage from home to work is a taxable benefit. So on that 40% tax should be conducted. At least you should know these details if you do not know the nitty-gritties of all that I have discussed, but these main points you should know. So guys, which alternative will result in the lower option, the lower cost? One or two? I have shown you the answers of both. In one option, it is 1812, and in the other option, it is around 1000. So the alternative one will cost him the lesser. I know it's a bit confusing, but these are the questions, or these are the type of the questions you should familiarize with yourself with by practicing again and again. But while practicing, don't, you know, bash yourself that how you'll be able to pass. These are the points that you need to learn to score maximum marks. However, to learn at least passing marks, if you know the main points, you will be able to score. And then the paper is split into different types of question. There are a few easy questions, there are a few difficult questions. In the easy questions, you can score well. In the difficult questions, you might not score that well. So not one question or one part will decide your pass or fail. It will be the complete paper. And you should keep that in your mind, everybody, that while solving the paper, we will come across some of the question that will comes naturally easy to us and we will be scoring well in them. However, there will be some question that will provide us trouble and we might not be able to score well in them. You should be mentally prepared like that. Now, with that, we have covered this part as well. Now, lastly, about the late returns, T filed the corporation tax returns for the year ended 30th April 2019 on 29 August 2020. So guys, they should have filed this tax return after 1 year of the date. For 30th April 2019, they must have submitted by 30th April 2020 and they have submitted after that. Now, I will check that whether they have submitted within 3 months. So it will be from the deadline, the 3 months will be May, June, and July. So they have not submitted in 3 months, they have submitted after 3 months. That is 3 to 6 months. So because of submitting in 3 to 6 months, they will be penalized for 100 plus 100. That is £200. Any question till here, guys? Okay, so I hope that I've answered your questions. Now, let's have a break and then we'll attempt our last question. And that is the question that, due to the time issue, we were unable to attempt in the first day. The question is max. If I'll share my plan with you, you remember that on the very first day, we were unable to do the max question. We have done CARDA, or I guess we haven't done the LIBOR. Guys, we haven't done the LIBOR or the max. Can you tell me? The ones who were present in the first day as well. LIBOR we haven't done. Thank you, Johannes. So we'll attempt LIBOR. So let's have a 10 minutes break and then we'll be back, and at 10:30 we'll start again. Okay guys, let's start. The last question for today is LIBOR from December 18, and the December 18 paper is available on CB practice platform. So we'll visit that. Sorry guys, December 18 exam it is. There you go. Now we read the requirements first. Guys, just sorted my voice. Can you raise your hands and let me know if it's clear now? Thank you. Now, LIBOR has requested advice on the timing on the sale of the shares which she acquired in the recent company takeover. His sister Vesta requires advice on tax consequences of making a lifetime gift rather than leaving an asset in her estate upon her death. The following exhibit, available on the left-hand side of the screen, provides information relevant to the question. The first is scenario, and then we have the requirements. So let's read the requirements first. Explain with supporting calculation the CGT implications for LIBOR for takeover of Vulcan Limited by Mercury plc on 1st June 2021 and a subsequent sale of his Mercury plc shares on January 22. So we have to tell the CGT implications along with supporting calculations, and the topic relates to takeover. We'll discuss takeover in a bit. Explain with supporting calculations why it would not be beneficial for LIBOR to sell his Mercury plc shares on 1st May 2022 instead of 1st January 2022. So we have to think that what normally can be the benefit of delaying the disposal. Normally what the benefits are, there is a chance that by delaying next year you may have a lower rate available to get your gains taxed. There is a chance that there are some losses that may be available in the future against which you can set off this gain, or there is a chance that today the annual exemption is not available, however in future it is available. So these are the key points that about which you always thought that will decide that whether we should delay the transaction or we will keep it as it is. Now, B, advise with Vesta whether or not there are any capital gains tax or inheritance tax advantages. For both, I'll be telling her. For herself or for Janus, if she were to gift investment property to Janus on 1st December 2021, rather than leaving it to him in her estate on death. So I know that LIBOR, who's LIBOR, and Vesta is her sister, but we don't know at the moment that who Janus is. So we'll see that. So let's read the scenario. LIBOR is a UK resident and domiciled, has taxable income of 30,000 each year. LIBOR acquisition of ordinary shares in Mercury PLC. So do remember her taxable income, guys, because it will help us to determine any implications. If his taxable income is 30,000, she's a basic rate band. Taxable income means after deducting the personal allowance, the income that will be subject to tax will be 30,000. So she's a basic rate band payer. Now, any income that will increase his taxable income, few of the income will subject to basic rate band and the remaining will subject to high rate band. LIBOR acquisition of ordinary shares in Mercury PLC. LIBOR purchased 800 of ordinary shares, a 40% holding in V Limited for 14,000 on 1st July 2011. So LIBOR originally purchased the shares in V Limited and it was a 40% holding, 800 number of shares. MPLC acquired 100% of the ordinary share capitals of V Limited on June 2021. So obviously that LIBOR, being the shareholder of V Limited, will now have become the shareholder of MPLC because MPLC have bought the VPLC. In exchange for any ordinary share in V Limited, LIBOR received the following: 4 ordinary shares in MPLC valued at 20 per share after the takeover and £15 cash. So we have to determine how much cash she would have received and what will be the value of her shares because we have to create a base cost. MPLC has 200,000 issued ordinary shares. LIBOR has never been a director or employee either in V Limited or MPLC. The takeover was a bona fide commercial reasons and not for the avoidance of tax. That's fine. So before I discuss this topic with you, I'll take you to my notes and we'll discuss in CGT the topic of takeover so that we can discuss that how we normally calculate the cost. Takeover reorganization. Whenever there is a takeover means that one company has acquired another company. And if you are the shareholder of old company, you will now have become the shareholder of the new company. Now, sometimes the consideration is only for shares for share, that is paper based takeover. In that, you will become the shareholder of a new company by giving the shares of your old company. No money is involved in that. If there is a share for share consideration only, there will be no CGT calculations on the day of takeover. Now, if there is a mix consideration that there is some cash and some shares are involved, then the share part will still qualify for the exemption of CGT at takeover. How only the cash part of the gain will be taxable. And that can be exempt as well if you fulfill small disposal criteria. That is, the cash proceeds that are received are either the less than 3,000 or 5% of the market value of the total consideration. So if they are less than 3,000 in a number, or if even more than 3,000 but they are 5% of the market value's consideration, then the share gain can be exempt as well. Now, if the QCBs are included, that are loan notes are normally exempt from CGT. So if you think like a tax planner, rather than me taking the shares, I can, if I have the control, I can suggest the company to give me the shares because the share part will be exempt for CGT anyways on the takeover, and give me loan notes rather than cash because If I take loan notes and sell the loan notes are exempt from CGT. So in this way, I'll be able to take my or save my gain tax. However, the rules are different for that, but because the QCBs are not being tested here, so I will not go into the detail. However, the QCB part of the gain is gets freezed as well, and it will be taxable later on. But we'll not go into the detail here about QCBs. All we should know is that the share part will be taxable, will be exempt, but the cash part will be taxable. And we have to calculate a base cost of shares and cash both on the disposal or on the takeover. So let's get back to the question. Now, Liber proposed transaction in MPLC shares. Liber now wishes to sell off all of his shares in MPLC. Now I cannot solve this part until I have solved the part above, and I can have the base cost of MPLC shares because she has not purchased the MPLC shares, rather she has received them as a result of a takeover. He has received an offer from an unconnected person to purchase these shares at a price of 28 per share. So proceeds can be calculated. Liber would prefer to sell the shares to his nephew Janus. This would delay the sale as his nephew will not have the necessary funds to purchase the shares until 1st May 2022. So guys, don't think emotionally here because we are not, going to suggest him what is right for the family. What we are going to suggest here is what will be the better from tax perspective. So don't answer that, sir, if he will delay his shares, his sale, his nephew will be able to buy. I mean, we are not here to, take care of nephew. We have to tell that what will be the impact if it delays the sales on taxation. So now Janus said that he will also pay £28 per share. So obviously she will not be getting any extra money in either scenario. Again, this will not be the right answer that if she sells the shares now, she will receive the money earlier, and if she will sell it the next year, she will receive the money the year later. You have to tell me what will be the impact on the tax of delaying the sale. So this will not be the correct answer as well. So first I have to calculate the base cost of the shares by doing the takeover calculations. Then I can calculate that what will be the capital gains on selling the Mercury PLC shares. Now, Vesta is a 66-year-old and has never married or had a civil partner, is in ill health and is expected to die at some time within the tax year 22-23. It means within 2 years because we are standing in the tax year 21-22. Has made no disposals for the capital gains tax purposes in the tax year to date and will not make any in the tax year 22-23. Okay, that's fine. Has made one previous lifetime gift of 350 cash to her son on 1st June 2020. So she has made the gift this year. However, because it is a pet, it would not have used her nail red band. Now, Vesta investment property. Vesta owns an investment property which has never been used as her main residence. The current market value of the property is less than the price Vesta paid for it, and its value is expected to fall further throughout the tax year 22-23. That's fine. So it is a loss-making asset now, and if you will keep it, its value will decrease further and your loss will increase further. Now Vesta is considering gifting the investment property to Janus in her lifetime rather than leaving it to him in her estate of death on death. So because it is an investment property, it is not an asset that can qualify for gift relief because gift relief can only apply on the assets that one is using actively in their trade and the donee will also be used that in their trade as well. So it cannot qualify for gift relief. So it would have been a chargeable transfer, but because the property is still in loss, so if she would have gifted it to Janus, it would have resulted in the capital loss if she wants to. So Vesta is considering that whether to gift the property in Janus in her lifetime that will result in capital loss, or leave it to him in her estate on death. If she leave it in her estate on death, then he will inherit it on the probate value, that is the market value at death, and he will have to pay any IHT on that after the nil availability of the nil rate band. So Janus is a sole beneficiary of Vesta's as estate. That's fine. So we will be discussing this part later on. Firstly, let's go back and do the calculations for the takeover. So for that, I will open the spreadsheet. Open the questions and that both side by side. Now, for takeovers, what you normally do is you always follow a two-column approach. Always, first, you see that what are the cost or the shares valued at before the takeover and what are the after. And for that, you always make two columns. One is market value. So one will be market value and one column will be cost. Now, now we have to calculate the cost of shares and the cash. So what we will do is, first of all, you have to check that what is the cost of the old shares that she has bought. It is 14,000. So you should remember that it is the 14,000 that you have to split between two. Imagine like a takeover that, let's say I have a mobile that I have bought for £1,000. Now you come and offer me, sir, if you give this mobile phone to me, I will give you a mobile phone and a smartwatch in return. And I was like, okay, the offer is attractive. You can take my mobile phone. Now, because the mobile phone and the smartwatch is not bought by me, so I do not have the cost separate for them. If I sell one of them, if I sell the cost, or if I sell the if I sell the my watch or my mobile phone, I do not have a separate cost for them because I have not bought them. I have received them as a result of an exchange of offer. Now, how do I calculate the separate value for my watch and the separate value for my mobile phone? One thing is for sure that they both have indirectly costed me for 1,000 because I bought my old mobile phone for 1,000. So if I have given you my mobile phone and you in return gave me a new mobile phone and a smartwatch, so for me both things are worth £1,000. Raise your hand if you have understood till here what I have said. I'll explain later as well. Okay, so that is fine. Now you know that the issue is that I do not know the separate cost of my watch and my mobile phone. So what do I have to do is I have to split my old cost between the value of a mobile phone and a smartwatch using some appropriate basis. Now that I will share you what are these appropriate bases. So every time you have to calculate the takeover calculations, always write the total cost first, which we are going to split. Now, after you are done with that, you have to see that how much shares have you received in return as a result of takeover, and how much cash have you received. You first have to calculate after writing total cost. So do remember that we can see here that as a result of takeover, 4 ordinary shares in MPLC has been received for every share. So if I had 800 shares, obviously I would have received 800 times 4, that is 2400 shares, and every share after the valuation was worth 20. So 2400, sorry, 3200. 3200 times 20, 64,000 is the market value of the shares I have received. I am not currently apportioning the cost. I'll explain you later on how I will apportion the cost. This is the market value of the new shares that I have received. So I'll write shares here. Now let's talk about cash. Obviously, there is no market value of cash. Whatever the cash I have received, I'll write it straight away here. But I have to see how much cash have I received. For every one share, I have received £15 cash. So obviously for 800 shares, I would have received 800 times 15, 12,000 cash. So the total market value of both the items that I have received is 76,000. Now I'll explain how you can split the cost between the watch and the smartphone. What you will do is you will calculate a percentage that out of the total market value, how much percent market value relates to the share and how much percent market value relates to the cash. For example, let's say if I calculate about cash first, so my total proceeds are 76,000 and my cash is 12,000. So 12,000 divided by 76,000, almost 15.8%. Out of total market value, the market value that belongs to cash is 15.8%. I'll multiply this to my cost and assume that out of total cost, I should allocate this amount of cost to cash, that is 21, sorry, 2210, and if I'll round it off, I can make it 2211. So 2211 can be the cost of the cash, and the remaining, the difference between both the 14,000 and the cost that I've allocated to shares can become the cost of my shares. Now, this is an assumption only. You can say that if you take my example of the mobile phone and a smartwatch, when you'll give me the smartwatch and mobile phone, let's say I went to the market and I've inquired how much the watch is worth and how much the mobile phone is worth. And I came home and I myself, on the basis of assumption that out of total market value, mobile phone and smartwatch is worth of £2,000. So I thought that the smartwatch is worth 30%. So I'll allocate 30% from my old cost to smartwatch and 70% to mobile phone. Now this is an assumption only, but this assumption has been taught to us by HMRC, that as to how you should calculate the market value of the shares and the cost of the shares. Now you'll be saying, sir, there is no actual such cost of cash available in real world because the market value of the cash and the cost of the cash is same. Yes, these are the only assumptionary calculations, and these are only being calculated to compute the gain on the cash element of the takeover, because HMRC wants to charge you capital gains tax on the cash element of the capital gains tax, on the capital section or the capital part of the takeover. Now, you should remember that the cash part will immediately be taxable. So cash proceeds will be whatever the market value of the cash, that is 12,000, less cost of the cash that we have calculated, that is this, and gain on the cash is this plus this. This is immediately chargeable, but the gain on shares will not be chargeable till the person will sell the shares. For example, in our question, Liber has decided that she will going to sell all the shares of MPLC. However, if she decide to keep those shares, there will be no chargeable gain this year. However, whenever a takeover happens, the cash gain will become chargeable immediately. So you have to remember that this gain will be immediately chargeable. And you can see it is neither less than 3,000 nor 5% of the market value. So that is why it does not qualify for both of the criteria, so it will be chargeable. It is a cash gain. I can write that separately, that it is a cash gain. Now, if she were to sell the Mercury shares, what will be the gain on shares? So shares gain, I'll copy all of this because it will be the same. However, I'll change the data here. If she sells the shares immediately to that unconnected person who has given her the offer of 28 per share and does not wait for Janus, then her proceeds will be 28 pound times number of shares she has received, and those were 3200 shares, the new shares. So her proceeds will be 89,600. Now, what will be her cost? Cost we have calculated already, 11789. So the gain will be 77811. And this will be the gain even if she sells the shares next year. Why? Because the cost will remain same and Janus will be paying him the same amount of money. I'll explain that what will be the impact by delaying the sale. But first, if you guys can raise your hand if you have understood till here. Fawad, the substantial shareholding exemption is only and only for companies. When one company sells holding in another company and the holding is more than 10% and they've kept the shares for 12 months. So substantial shareholding exemption has nothing to do with individual. Yes, whenever an individual sell the shares, BADR is available. So I'll ask you guys, is BADR available here? Guys, BADR available here for LIBOR? Okay, Rubina is saying yes. What about you guys? Anyone else? Johannes and Fawad, the answer is no. If you remember that when we were reading the question, it was clearly mentioned that LIBOR is have never been a director or employee of either V or M PLC. So you know that the criteria is that number one, the ownership should be more than 5%. You should be employee of the company and the qualifying period is 12 months. So because she is not the employee, she will not be able to claim BADR on this. Whether she sells the share to that unconnected person or to his nephew Janus. So that doesn't matter. I have tried to explain as slowly as I can about the takeover because it is a pretty confusing topic. So I hope that you guys have now understood that why do we do the calculation in such way. Now, I'll be needing answers from you that what will be the benefit if she delays the sale and what if she sells this year. So first of all, let's calculate that what will be her CGT if she sells the share this year. So total CGT will be gains, and gains include the shares gain and the cash gain. This will be her total gains less her AEA, that is annual exemption amount, that will be 12,300. So her taxable gain will be this. However, the question is asked to tell us about the CGT implications. If she would have been mentioned as a higher rate taxpayer in the question, I would have immediately multiplied 20% and whatever the answer is, that would have been the gain. But the examiner has made the question difficult for me by telling that her taxable income is 30,000. So now I know that 7,500 of the remaining basic bed has been left. So 7,500 of the income will be taxed at 10% and the remaining income will be taxed at the higher rate. So let's calculate her CGT liability. So 7,500 will be taxed at 10%, that is 750, and the remaining will be whatever it will be 75,300 minus 7,500, it's 67,800. That will be taxable at 20%. So this amount times 20%. So the total CGT liability will be this plus this 14,310. Considering she sells the shares this year. However, the cash gain will be chargeable this year whether she sells the share or not. However, the shares gain can be delayed to be charged this year by delaying the sale till next year. But you guys tell me what will be the advantage by delaying the sale next year, because the proceeds will gonna be the same, the cost will gonna be the same. So what will be the advantage? Spot on, Johannes and Fawad, that one of the advantages separate annual exemption available. Then the second, spot on Fawad, basic rate will be available again next year as well, provided that if her income continues to be 30,000 next year. This year, what will happen? If she delays the shares, all of her cash income, the cash gain, will be covered by the annual exemption and she will not have to pay any IHT or CGT this year. Now, if she delays the sale till next year, all of the annual exemption will be available to the shares gain solely, because there will be no cash gain next year. Secondly, there will be some basic rate band as well available next year. So as you know that we have to always tell them the differential tax savings. So what I'll do is I'll calculate the tax liability next year as well. So for that, I will copy all of this data because that will help me, and I'll just change the figures. So the gain next year will be the same, that is On shares, the gain is 7,811. Less the annual exemption, the taxable gain will be this. Out of that, 7,500 will be taxed at 10%, and the remaining gain will be taxed at 20%. That is this amount minus 7,500. So this will be the tax next year. It will be 12,352. So CGT savings will be this minus, rather I select that one first because it was higher last year. This minus this. 1958 is the amount of CGT that she will be able to save if she decides to delay. That is CGT payable. Copy this. This is CGT payable as well. Here you can write sale in 2021. You can also copy that and paste it here as well. And change it as 21-22. I'm trying to teach you shortcuts so that in exam you never complain again and that sir I was out of time. You have seen that I have done the calculations here. There is no point to write again this gains, annual exemption, taxable, and even because I've applied the formulas, he has copied the formulas as well here. So I just had to change the amount of the gain and till the tax he has calculated himself, the software. Now, guys, raise your hand and tell me that you've understood not only the concepts that I was trying to tell here, but also the way I want to teach you that how you can solve it on the spreadsheet. Thank you. Now, some of you ask, sir, how will we explain and how we will calculate? Now, what you will do is, after doing this calculation in the spreadsheet, you will click on the word processor. You will explain what you supposed to do or explain if the library was sitting in front of you and you had to communicate her with on paper. Now you yourself tell me that if you hand over the library this calculation without telling her anything, will she have a clue what you have done? Obviously not. So you have to explain each and everything, that is, and without incurring any extra time or wasting time. You'll just explain in a very precise way, and you'll start with that on the takeover the gain will be split into two parts, that is for share and that is for cash. However, the gain for the cash will be immediately chargeable regardless of the sale of the shares. For shares, the gain will not be chargeable until she decides to sell the shares. Then you will mention that on the shares she will be having a chargeable gain of this, and then you'll explain that if she decides to sell the shares this year, her complete CGT liability will be this. However, if she decides to delay the sale in the next year, the complete annual exemption will be available and basic rate band will be available, with the help of which she will be able to save the CGT, and the resultant savings will be this, and on front of that you will write C spreadsheet. So the examiner will themselves be looking at the spreadsheet. But your format should be that it should make the life of the examiner as easy as possible. So guys, are we okay till here? Raise your hands if you allow me to proceed forward. Thank you. Now, let's talk about the third part in which she has asked me about the advice to Vesta. In requirement, I have to advise Vesta whether or not any CGT or IHT tax advantages for herself or for Janus if she were to gift the investment property to Janus. So I'll stop here. If she gifts the property to Janus now, it will result in capital loss. But she cannot relieve that capital loss because it is mentioned in the question two things. Number one, she's about to die soon. And number two, she will not be using or she will not be making any capital. She will not be disposing of any assets here because it was clearly mentioned in the question that she has not made any disposals during the tax year and she will not make any in the future. So what is the point of realizing a capital loss by transferring a asset or a gifting asset to your son when you will not be making any disposals to realize that loss? So there is no advantage to you. Now, about Janus. If you give it to Janus, obviously the Janus will be acquiring at a loss. So at the moment, the Janus will not have to pay any tax because he's not getting the asset at a gain, he's getting asset at a loss. So Janus will not have to pay any tax and you do not have to pay any tax as well. That is for the CGT's point of view. Now let's discuss what would have happened if she were to leave it in her state so that it will be transferred to her, to him, to Janus through the death estate. Now do remember when you transfer the assets during the lifetime, they are considered to be pet in IHT. So in IHT there is no implications. However, in CGT there are implications. So if she gives the house or the investment property to Janus in her lifetime, it will be recorded as a pet in IHT. And in CGT I have told you the implications. So guys, what happens that if you have given or being a donee, if you have received a pet from someone and that person dies within 3 years, so you being a donee now have to pay the tax on that, IHT on that. Normally what happens is the value of the asset gets locked at the time of pet and any rise in the value will not be subject to IHT. So the donee gets advantage that whatever the old value is, he pays the tax on that. Now you tell me guys, what if the opposite happens, rather than asset increasing or gaining the value, it loses the value. So can the donee applies to HMRC to reduce the value or do he has to pay the tax on the old value? You tell me, old value or the new value? Guys who do not know about a relief called fall in value relief, only they are answering me the old value. There is a relief in IHT that is called fall in value relief. Fall in value relief is that if you have received an asset as a donee from someone and they have now died and that asset has become chargeable and now you have to pay the IHT. You can claim a relief called fall in value relief from HMRC that the asset has fallen in the value and HMRC will provide you a relief that you can reduce the value of the asset to the value that it is fallen onto the death. So let's say if I have inherited an asset and at that time it was valued at 100,000, but when the person died after 2 years, it fallen to 80,000. So HMRC will allow me to claim a fall in value relief of 20,000 and to reduce the value at 80, and then I'll pay the IHT at 80%, at 80,000. That is what a fall in value relief is. So you are secured from both ways. If the value would have increased, the increase will not subject to IHT. However, if the value will decrease, HMRC will provide you a fall in value relief. So raise your hands if you have understood what a fall in value relief is and what are its implications. Now, because she is going to die within 2 years, it is mentioned in the question whether she gives it to her or she leaves it in her death estate. Either way, Janus has to pay the IHT on the value that will be on the death. So there will be no advantage because no taper relief will be available because she will not be able to live more than 3 years. Otherwise, I would have suggested to transfer it now. At least taper relief will be available. So I guess I will suggest that this, as per the circumstances, it does not make any difference whether you gift the investment property to him in your lifetime or at death. Fawad is saying that I can claim an exemption, annual exemption, which can reduce the value of the asset by 3,000. But Fawad, that would have been beneficial for me if the asset would have increased in the value. The question is saying that the asset will decrease in value further. So rather my annual exemption will be wasted. What do you think? Don't you? Okay. So the thing is that there is no difference whether she gifts the property to him now or she leaves it on her death estate. However, from the CGT's point of view, there is one advantage that if she gifts him the property today, the value of the gift will become the base cost for Janus. And if the asset will fall in value further, whenever Janus will sell it, Janus will able to claim a loss at a higher rate because his cost will be higher and his proceeds will be lower, so he will result in higher loss. So guys, with that, I have summed up this question as well. Raise your hand if you have understood. Now I'll give you few short tips as to what you can do in the last month. Revise the notes once. Try to solve the maximum questions from the Kaplan kit. Do not try to learn the rules by reading notes again and again. Try to learn them by doing questions from the kit. Read examiner's article of finance exchanges. Get yourself familiarized with that and try to solve the questions on either CBE platform or the Microsoft Excel spreadsheet. In this way, while solving the question, you yourself will be able to figure out shortcuts. You know how I have figured out the shortcuts? When you keep working on a software again and again, either for educational purposes or for the business purposes, with the passage of time due to learning curve, you are able to develop few techniques that help you to save your time. So even if you learn them as a student, it will not only help you at your educational point of view, but also when you'll come into the practical life, we don't, I mean, that time has long gone when we used to do calculations on paper. It's now a digital world, guys. You send emails to the clients. The tax returns are submitted electronically. There are softwares to calculate the tax. Nothing is now manual. And ACCA, being the most forward-looking qualification, has taken this step to make the questions or to make the papers computer-based so that whenever the student enters into the practical world, the spreadsheet, the word processor, the computers is not alien to them. So that I suggest that you should try to work hard as much as you can on your computer skills, because these are very critical to your success in the June 2021 exam, because in remote invigilation you do not have any chance of errors. Now, out of you who are sitting in the remote invigilations and will are sure that they'll be appearing in the exam, raise your hands. How many of you are opting for the remote invigilation exam? Okay, and what about the center-based exams? Okay, so most of you are opting for the center-based exams. That is fine. So best of luck, guys. If you have any questions, you can ask me. Now, I hope that you have found these sessions helpful. I have tried to, uh, Fawad, you can get the recorded videos I have shown on my lectures, that you just have to click on, you just have to write on Google, practice to pass ACCA. Whatever the first link is, it will take you to the main page of practice to pass. There's a link called practice to pass handout. If you click on there, it will take you to the ACCA's Vimeo channel, and there the lectures are available. However, it takes 24 days after the lecture gets available. Yes, Johannes, I'll post my email here so that you can have it. There you go. Do you have anything related to? No, guys, the examiner cannot ask anything related to COVID-19 because this is a taxation exam. And all of the grants or the new rules that have been announced for COVID-19 will not be tested in your exam. That has been mentioned in the article as well. So guys, I hope that you have found these lectures beneficial. It have made it the topics for you easier, more understandable, and you have the right mindset to approach the paper. Do remember that paper will be full of easy marks. Do not get stuck on difficult questions. Do remember that there will be some questions you'll find difficult. However, there will be some from where you can score easy marks. Focus on ethics. 5 marks ethics for sure. 4 marks professional. 18% marks can be achieved in this way. And then from here and there, try to extract easy marks. And do remember, although you would have been almost tired while you will approach the section B, because very tough are the section A and B questions. But do remember, unfortunately, the most easy marks are there in section B. So do remember, while you'll be solving section A, then hopefully in section B, there will be some easy marks which I can gain. So if the section A questions are on difficult topics, don't be disappointed. You have to hold your nerves till the end of the paper. Okay? So best of luck, guys, and I'll see you in the next section. Johannes, I have sent it. Check the message that you have sent me and reply to that. So best of luck, guys. Take care. Allah Hafiz and bye.